Risk management is a critical aspect of financial decision-making. One of the most widely used risk measures is value at risk, or VaR, which estimates the potential loss of an investment portfolio over a given time period with a specified confidence level. What is value at risk? VaR answers the question, what is the maximum expected loss over a specific period with a given probability? For example, if a portfolio has a one-day 95% VaR of $1 million, it means there is a 5% chance that the portfolio could lose more than $1 million in one day. Methods to calculate VaR. There are three main methods to compute VaR. One, historical simulation, uses past market data to simulate future losses. Two, parametric method, assumes returns follow a normal distribution. 3. Monte Carlo Simulation uses random sampling to simulate a wide range of potential outcomes. Why use Monte Carlo for VaR? Monte Carlo simulation is particularly useful when dealing with complex portfolios and non-normal distributions. Unlike other methods, Monte Carlo can model fat tails, skewed distributions, and nonlinear risk exposures. Advantages: flexibility, works with any type of financial instrument or risk model. Captures tail risks, accounts for extreme market movements beyond normal assumptions. Adaptability, can be applied to portfolios with options, derivatives, and illiquid assets. Steps to calculate VaR using Monte Carlo. 1. Define the portfolio. Identify the assets and their weightings. 2. Model asset returns. Use historical data or statistical models to estimate return distributions. 3. Generate random market scenarios. Simulate thousands of possible future market conditions. 4. Recalculate portfolio value. Compute portfolio returns for each simulated scenario. 5. Extract VaR from the distribution. Sort simulated returns and identify the worst losses at the desired confidence level. Example of Monte Carlo VaR calculation. Suppose we have a $100 million portfolio and we want to compute one-day 95% VaR using Monte Carlo. We generate 10,000 random return scenarios using a probability distribution. After sorting the portfolio losses, we find that the worst 5% of scenarios result in losses greater than $2 million. This means our one-day 95% VaR is $2 million, indicating a 5% probability of losing more than $2 million in one day. Challenges of Monte Carlo VaR. Computationally intensive, requires thousands or millions of simulations. Model risk. Results depend on assumptions about return distributions and correlations. Data sensitivity. The accuracy of VaR depends on high-quality market data and volatility estimates. Applications of Monte Carlo VaR in finance. Monte Carlo VaR is widely used by banks and financial institutions to measure risk exposure, hedge funds to assess downside risk in trading strategies, regulatory bodies for stress testing and capital allocation, corporate risk managers to evaluate potential financial losses. Conclusion. Monte Carlo simulation provides a robust and flexible approach for calculating value at risk, making it an essential tool for financial risk management. By simulating thousands of possible market scenarios, Monte Carlo allows investors and institutions to better understand potential losses and prepare for extreme market conditions. Despite its challenges, Monte Carlo-based VaR remains a gold standard in financial risk assessment, offering insights that go beyond traditional models.